channel host, back from Disneyland for my birthday, and also back from our 76 unit walkthrough. So, welcome everyone. We had the 76 unit walkthrough today. It went fantastically. I'm super excited to tell you guys about some of it. Though I will not, I'm going to stop talking about some of the specific pricing pieces. I've been told I should not do that on a live. So, um, we went down to Stephenville today. By the way, Texas is 12 degrees. 12 degrees outside. It is frigid when I went down there, covered in snow. But we did the walkthroughs, went through the units, guys, absolutely huge. I'll be posting some pictures today on Instagram. But the units, they're 2-bed, 3-bed, 4-bed units. They're 2-story. It's a 14.5 acre campus. So that walkthrough just went fantastically. This is a tactical advice too when you're doing these walkthroughs. Best practice, you try to get a walkthrough of every single unit. Since these are all, like there's only 3 different types of unit type. There's 2, 3, or 4 beds. We did a random sampling today, one in every single building, but we didn't walk through every single unit. We looked in the attics, the garages, the roofs, the foundation. So we got a full exterior of every building. Interiors, we did a random sampling out of the 76 of about 25. So we knocked out about a third of the total buildings on top of the clubhouse, the pool, the whole 9 yards. So with inspections, you want to make sure you're looking at all the big items. It's important to note inspectors don't catch everything, but they do catch a lot. So we found that there are some ACs that are hooked up incorrectly per code in the ceiling. There were basketball hoops in fire lanes. So these are all little things. These are simple, inexpensive fixes. Basketball hoops sitting in fire lanes. There are barbecues backed up against the building, which insurance would not be a fan of. So looking through all of the pieces that make up this deal, I was looking at it saying, okay, this actually, one, the buildings are awesome. They look fantastic. They're clean. They're beautiful. They're super spacious. I remember walking through that being like, wow, that 4-bed, I'm like, I would move my family into this. If I was moving to Stephenville and I was looking for like, hey, where do I want to build a house? I would live in that for a year without question. Huge units, 4 bedrooms, in-unit washer and dryer, dishwasher, ovens, your whole 9 yards. It is a nice place to live in a nice area of town and a huge campus with a pool and a clubhouse. When we see these type of things, it is super exciting. When we do the walkthroughs, and yeah, there's a lot of stickers on doors, banged up trim. But when you're looking at these, in overall, they're in like, let's call them an 8 out of 10 for condition. It's super exciting. It's super exciting. So just got back from that recently. We're hopping on the live here, going from my phone because my computer doesn't want to turn on upstairs, and I didn't turn on the heat. So while it is 15 degrees outside right now, yeah, the upstairs of my house did not have the heat on, so it's also freezing in my studio. We went through that. That is definitely going to be a really good looking inspection. We'll get the final report. But the important thing with these inspections is that you actually walk through the properties yourself. That was the big thing for me, is actually getting on the inside, going through the garages, looking at everything, no matter what level you are an investor. And I have hundreds and hundreds of units. When I go through these buildings, it's the exact same process. We look at everything, we document everything, we ask a lot of questions. I have a friend who bought a deal in Ohio, and she never walked the property. She skipped the inspection because she's like, oh, the price is so good. When contractors came in to fix it, they fell through the second floor into the first. Now, luckily, they didn't get injured, so there wasn't a lawsuit there. But that's the type of stuff you want to avoid. She bought a property that had major deferred maintenance, and she thought it was going to be mostly cosmetic. When we get in here, this one does just need some cosmetic improvements and a couple of compliance improvements. Move a basketball hoop out of a fire lane, take barbecues and move them away from buildings. Ideally, there's a huge field in the middle of the campus. I think some built-in barbecues would go a very long way for the community there. Paint the gazebo. It's stuff like that. It's little teeny things. Beautiful campus, super exciting. Also, I'm now 33. Quick update on me. I am back from Disneyland. I was there this weekend, hence the just disrespectfully loud shirt. I have a quick tip for everyone who reaches any level of financial independence and wants to go to Disneyland. One, go to Disneyland on an off day. If you don't have a traditional 9 to 5, or you can afford to tell your 9 to 5 they can shove it, just go on an off day. Super fun. Number 2, there was a $400 pass. I believe it's called the Lightning Pass. It is in addition to your ticket. So you get your Disneyland ticket and your California Adventure ticket. This is for California. You pay $400 additional dollars. You get a fast pass that is not time gated for every single ride. In one 13-hour day, we did every ride, went out for lunch, went out for dinner, leisurely walked around the park, and the longest line we stayed in was maybe 10 minutes. Most of the rides we basically just walked on. If there's a way to do it, this will save you money because you don't take 2 days to go through the park. You can do it in one shot, really casually. You can get a beer, you can go out for wine, you can get Italian food, you can go to Blue Bayou. All of those things we did one day. Highly recommend. I understand $400 is a little addition to a ticket. That was the best gift my tenants have given me this year. Fantastic experience. Highly recommend. By the way, as always, we do answer any questions in the chat. So if you guys have any questions, you guys can always post below. Usually, I do these things horizontally from my studio, but today we're going from the phone, just fresh out of the car from the walk through the 38. It's about an hour and a half south, which brings me to my last point. This is why I like living in driving distance from my properties. Does your market mean literally investing in your backyard? In Washington State, when I lived in Seattle, I invested 3 hours away. But I could drive there. I could do these walkthroughs. It was time efficient for me to get over there. Not to be there every day, not to do my own work, but it was very efficient to manage those properties, to run that portfolio myself personally. For you, you look at wherever you have competitive advantage. If you're in a market that's really, really competitive and you just can't, so say you're living in like LA and you're having trouble investing in LA, even though I have friends who do it, if it's just not moving for you, you're probably not going to invest there. But say, for example, you have family out in West Texas and you can run the portfolio better there, or you're from another state and you know another market well. All you're really looking beyond just the backyard is one advantage. But what areas in the US do I have a unique competitive advantage? And are those markets that have population growth? In this case, Stephenville, Texas, it's an hour and a half drive. Is it my backyard? No, it's definitely not my backyard. It's several counties south. That being said, it's an amazing place. It is an easy day trip. I was able to bring my wife and my newborn baby down. Well, he's not newborn anymore. He's going on 4.5 months. But I was able to bring a wife and kid down there, no problem. Tour the buildings, do the walkthroughs, go to our 44 unit. I installed 3 door locks, hooked them up to a Wi-Fi gateway. Now I can control the locks for the clubhouse for our senior living facility. I can control those all from my phone. So once we replace the lock for the main office, which decided not to work today, I want to make sure we can actually lock everyone's personal information. Once we lock that up, bingo night resumes, Bible studies resume. We have time-gated access on the internet, and if anyone has any special bookings of the clubhouse, we can text them a key that they can plug into the door, or they can just open their phone and hit the unlock button in a certain time window. Automating locks in that building is one of the best things we've done. I was able to knock that out and inspection and get back home for the live roughly on time. That's pretty good. That's what I'm talking about by investing in an area where you have a competitive advantage. Oscar had a quick question here on last week's topic, actually, the debt hammer. When you do a negative AM, what is the negative AM or interest-only strategy? How does that work? Can you explain the debt hammer again? Yes. So you have 4 phases of business. You have the build phase, which is where you buy all the properties to actually generate the top line income that's going to get you financial freedom. You also typically get enough cash flow to leave a job in that phase. So buy till you hit your minimum cash flow goal. Number 2, we are stabilizing. Now you're doing this during the buy phase, but you're going to finish out stabilization. This means 95% occupied at least 90% of market rent. So mostly full, mostly bringing in what it can in its current state. This is a stabilized portfolio. It's a good place to be. Number 3, we have optimization. That's where we're going to do major improvements, exteriors, new windows, add a park bench, the things that make the property better, optimal to push your rent to the maximum that it really can be while your tenants are still getting tremendous value. You do this by looking at all the surrounding properties and say, hey, is what I'm doing better? If they're doing one thing for flooring, is my flooring better than theirs? It doesn't mean it's a A+. It means it's the best in class at its price. And when we're optimized, we now have maximized the cash flow. We can start rolling down the debt with the debt hammer. Debt hammer simply says, if I'm going to buy multiple properties, so say I have 10 properties, amortized schedule, all of them are slowly being paid down over time. Far better way to pay off debt and far safer. Pool all the money. Do interest only or less than interest only on negative AM, but that's very rare and very specific. For simple example, Interest only. You might go, wait, we're not paying down the loans? No, but you're also not spending the money. All the money that would pay down the loans goes into one side account, which is interest bearing. That money grows and grows and grows and grows and grows. When it is equal to or greater than the amount of your smallest loan, you pay off a loan. Now your global cash flow has gone up. You keep saving, but now even faster because you have less debt. And you knock out the next loan, the next loan, the next loan. It's like the debt snowball, but instead of spending the money slowly in the property over time, it's sidelined. So if you have an emergency or anything comes up, in your portfolio, you can take that money and solve a problem instead of have it locked up in your property and have to borrow against your property to pull it back out. You can pull it out of an already interest bearing account for free and just pay for your problems. It is both solving the liquidity and like your actual reserves. It's solving reserves and liquidity while also giving you the ability to pay off your loans in full. That is what the debt hammer strategy is. Zeke asks, how do I still cash flow after refinance? What do I consider when I try out when I try about investors? If you paid them a ton of cash flow through the deal, often you buy them out at principal. Like if I was paying you 10%, I might be paying you 10% for 2 years, and then I have a right to buy you out at your principal value somewhere in that period, but you're getting a great return on your money throughout the entire deal. If there's less cash flow, you're going to have a higher multiple. So if I have no cash flow shared with you in 5 years, I'm probably doubling your money or something around there. It's completely variable. But if you have a deal with a lot of upside, you're giving equity. If you have a deal with a lot of cash flow, you're giving more cash flow. So at refinance, you're either cashing them out at value or at some multiple of their money, dependent on how much cash flow you're sharing in your deal. Oscar asks, when negotiating terms for owner finance deals, are you asking for interest only or negative AM? Almost negative, almost never negative AM. I've done that on one deal because that is what it needed to cash flow. What I would have preferred to do is start at lower interest and then the next month have the interest go up and the next month the interest go up. That's a cleaner way to do it. We did one at a negative AM, which means you're paying less than the interest and the remainder is added on to the principal. So your actual amount owed goes up. That's not great for your debt hammer if you owe more and more and more over time. This worked because it allowed us to cash flow while we got incomes up. And then the negative AM disappeared in year 2 when the property was already completely stabilized. And now it's just interest only. You want interest only. Negative AM is very specific when you have a good deal at a great price. There's a lot of upside, but you cannot go any lower in interest. You can essentially lower your payments below the interest. It is a very specific play, and it only works if the added principal, in my case, $50,000 of principal added to the deal, is still a good deal. I would have bought the deal for $2,050,000, so adding $50,000 to my total note at the end of it was totally fine. The numbers worked, but negative AM, out of 23 or 24 deals, I've only used it once. It was only appropriate to use once. Oscar, is it realistic to do 2 cash out refis within a 6 to 7 year period and use one of the refis to pay off a note, owner finance, second refi to pay out equity partners? Typically, you do the equity partners. Well, if you do a refinance, it's going to pay out the first position note no matter what. The remaining pays out the equity partners. Usually you do one. You usually wouldn't do multiple. You wouldn't do one to pay out. And what happens is you end up with prepayment penalties. You get lease fees. It's expensive to just keep running a whole bunch of refis. You usually do it all in one. The cash out pays off your investor, and the initial part of the refi is replacing the first position debt. So the seller should get paid off no matter what. What are 2 of the best creative strategies you have used or seen in owner finance? There's a lot of them. My favorite of all time is the Hummel hack. I did that lower interest payment. I call it the ladder, where you start at like 2% interest, then you go to 3, 4, 5, up to whatever it is the seller wanted, giving you time to increase the income to match the payments. Caleb said, hey, I have a deal that works if I have no payments for 6 months. I can get the rents up and lease these 2 units, and then it cash flows like a monster. So he did that deal and it worked really well. That's called the Hummel hack, which is just no payments for an extended period of time. They don't accrue. You give them a down payment and then you don't make any payment for a fixed period of time, allowing you to fix the problems in the property without getting a cash flow drain. Another creative finance strategy that I really, really have enjoyed is that ladder strategy of, okay, You don't want no payments, but what if I have lower payments in year one, a little higher payments in year two, a little higher payments in year three, and the interest changes over time? That has been a really good structure for me that's allowed me to buy a lot of real estate. Do you guys have you done deals with only bank debt, no cash down because of the LTV? No, banks will not do that. Banks don't do 100% loan to value. You can with some banks. It's rare, but you can do it. You can go 100% financing, say if you do like 50% bank, 50% seller financing. As long as the bank's in first position, they'll probably let you do that. They won't let you do a zero down deal. Most banks and institutions will only lend up to 75 or 80% loan to value or up to 90% blended debt, which means say they lend 60 and the seller lends 30. So you have a first and second position. They'll let you go up to 90% LTV. They'll still want to see 10% come from you or an equity partner. Let's see here. Where do you find accredited investors? Meetups? I don't care about accreditations. I've only ever done JVs, so I can partner with anyone. Doesn't matter at all. Your accreditations, what you make on your tax history or your W 2, has nothing to do with buying real estate whatsoever. So I don't look for accredited investors. You'd probably find them at meetups. Also, if you just do owner meetings like I do, you just meet other owners. What ends up happening is people who've owned real estate for a long period of time also have a lot of money and also would hit the accreditation. But I'm not syndicating, so I don't care about accredited investors. Even if well, I'm actually looking at syndicating on the 76, but that will be open to up to 35 non-accredited investors, and we should be able to do this with. I'm guessing we'll probably have 4 people on the deal. It's $1.8 million raise. We'll have 4 to 10 people on the deal. They'll probably all be accredited, but they absolutely don't have to be. They absolutely don't have to be. It doesn't matter as long as you file correctly. There is a 503B and a 503C that you can file. One is only for accredited investors, but you can market, and one you're not allowed to market, but you're allowed to use up to 35 non-accredited investors, which we won't have anywhere near 35 people on that deal. What if it's 60%, or what is it? 60% LT? Oh, yeah. Okay, sorry. You corrected below. Yes, what if it's 60% loan to value? Purchase price of 500K, but it appraises at 800. They will stay to their ratios on purchase price. So it's not based on loan to value. If I bought, for example, I bought a mobile home park that was worth $1.2 million. I bought it for $330,000, which is astounding. The appraisal said it was worth $1.1 million. It was really worth $1.2 million, but appraisal came in at $1.1 million. I bought it for 330. A bank would only give me 80% loan to purchase price because their underwriting departments say, hey, if they're buying it for this, we're going to assume that that's what it's worth. For its first year, we're going to assume that whatever they buy it for or the appraisal, whichever comes lower, is the value. That is how a bank's going to look at it. That being said, it was no problem at all to go to a private money lender and borrow 100, and on that one, I did almost 200% loan to value. I borrowed almost 600,000 to buy it for 300,000. I took that extra money and I built a new septic field and I did some upgrades to the well. I did some upgrades to units. I did a re-gravel of the lot, and all of that was paid for at close. So I did that was not a bank, but with a private money lender, it cash flowed while borrowing about 200% loan to purchase price. How many crews are active on a single project? I've imagined at least one crew for every 10 units. I wouldn't say that many, actually. I'm thinking about it. Because we actually finish projects while we're doing other projects, there's not just always things going on in every building. The most people who've ever been working on my portfolio at the same time has been about 40. But generally speaking, over 300 units, there's usually 3 or 4 crews working at any time at any given. So it's actually closer to like one crew per 100 units, is what I'm seeing as far as projects. Now, depending on the project, like with the hotel conversion, there were times where there was 4 crews working on that building, where we had electricians, roofers, painters, and people working on the interior at the same time. After that project, we did phase two, and now we're on phase three. So we've had multiple phases of multiple people working on the same building at the same time. But more often than not, I'm buying roughly stabilized properties that are mostly, they're sitting at fairly strong day one cash flow. So when someone comes into these, we're not disrupting a bunch of tenants or doing major projects all at the same time. There's usually not a ton of crews working at the same time. Now, my Afraid of project, which I am going to talk about, I will be doing a presentation, by the way, on the Facebook page. You guys haven't joined that, go to any of my, not my live, but any of my videos, like the normal post on this channel. There's a link to the Facebook group. You can join there. This Saturday, I'm going to be doing a presentation on the project I'm doing in Afraid of Washington. I am going to be looking for up to two people, one or two people. We're going to take $700,000 to take 3 buildings. We're going to renovate one of them completely. So I'm going to vacate the building, and it is like $150,000 a reno. It's going to be awesome. We're going to have 4 crews working around the clock on that building. On the 12-plex building, we have 2 units to reno. We're going to redo all the plumbing, all the bathrooms, half the windows, and paint and re-gravel. And then downtown mixed-use building, one of my favorite buildings, is being wrapped into this. I own this building currently, but we're going to take the remaining dollars. We're going to renovate one multifamily unit. It's a building with a barber shop, and it's super cool. It's downtown. We are going to renovate one of the upstairs units that are just absolutely ginormous. That building only has $320,000 of debt on it. We are going to take the revenue on that particular building to an insane level. I'm going to take out an entire portfolio and all of the renovation. We're probably going to have 6 or 7 active teams on those 3 buildings for 26 units. It is going to be an awesome, awesome project. I'm going to be sharing more on that on the Facebook page. I will be at some point here in the next few weeks. I am going to be looking to put together the team to do that. So we'll have either one person probably comes in with like 700,000, or it'll be 2 people at about 350 each come in, and we're going to do a stellar, stellar project in the like downtown area of Ephrata. Super excited to share that one. So that will be an example of the most crews I've ever run at the same time, because we're going to be doing 3 buildings in a absolute sprint all at once at the same time. It's going to be super fun. Do you aim for stabilized turnkey multifamily or BRRRR value add? Neither or both, I guess is the answer. I look for multifamily that cash flows day one. There are deals that are BRRRR, which is great. You refinance and buy out the partner. There's deals that are just really high cash flow. There's deals where I've done without partners, without having to raise any money, just bought them with hard money because they cash flow so strong. Which are turnkey too. I've done turnkey where the best structure for it was a long-term partner where we just cash flowed for a long period of time. There wasn't a huge exit where we all pull all, we burr all the money out. There's somewhere they're appropriate to park a lot of money for a long period of time at a great return. There's other deals where there is a lot of value add and you do pull the initial capital out. So it depends on the deal, but I'm not specific to one deal type. I think that is a poor model, is falling in love with one strategy. I love value add. But when I do the value add, I have a stabilized building. And so I like having a stabilized building that becomes turnkey. If you're going to offer me a turnkey building and I don't have to do a lot of work and it's still cash flow, I'm very likely to buy that as well. So I would say both and. I would do more than just those 2 strategies, but I don't marry any one strategy. My ultimate goal, own a lot of affordable housing. And if you guys have seen my affordable housing, it's nice affordable housing, but it is affordable, which means in a down economy, no one's really going to move out. It's still the nicest inventory at the best price, and it's all profitable. If you can build that portfolio, you're pretty much economically resistant. Long-term cash flowing fixed rate debt and entry-level housing never makes sense for them to downgrade. Sometimes tenants will make more money, they'll upgrade, they'll move out. Down economy, those same people come right back to your nice building. All right, appreciate you all. I will call this a wrap here as the questions have just dried up, but 76 unit going fantastically. Very excited to close that project. The Afraid of Washington project, I'll be sharing a little special Zoom if you guys want to check out that deal and what we're doing there, how we're structuring it. It's actually a really cool backstory. So if you guys want to see like how we're doing heavy value add, and this is a heavy value add with a lot of upside. If you guys want to see how we're putting together those type of deals, check out that Zoom. You're all invited if you're part of the Facebook group, which is free. Click the link in any video. If you guys come in on that link, I will accept all of them for today. So it's a private group, free access to everyone who's here on the live or watching the live here over the next few days. Appreciate y'all. See you on the next episode.